Welcome back, everyone, to Vox Markets Live. My name is Paul Hill. I'm delighted again to be able to speak to equity analyst and stock markets commentator Paul Scott from Gozo about all things small cap. So welcome, Paul.
Thanks, Paul, and hello, everyone, in particular, Paul the Parrot and Ben, who are nearly always on every week.
Yeah, well, it looks a bit dark there, Paul. You've obviously got the clouds out in the sky. We've got beautiful sunshine here on this side of the North Sea, so bad luck.
Yes, exactly. It's tipping it down here in Gozo, but never mind. Can't have everything.
Yeah, well, it's also tipping it down on the in the markets at the moment. In fact,
Yeah.
the last couple of weeks has been pretty eventful, largely by Trump and his America First strategy, tariffs flip-flopping all over the place. We've obviously got the turmoil in Ukraine and still in Gaza. Plus, we've got Doge now happening on the other side of the Atlantic as well. He's having Elon Musk's team's having a sort of the hammering of the way at the government finances. But the sort of like just the top level key messages for investors. What do you sort of take away from all of this volatility and uncertainty?
Well, it depends what type of, whether you're an investor or a trader, doesn't it? I mean, I put something soothing into my report today, my daily report on Substack, because particularly newer people who are newer to the markets need a bit of hand holding. And I think that my main message, I think, is similar to you when we talked earlier about this. It's don't panic. You know, if you're in good quality, decent shares, the share price can go all over the place because it's just a second-hand market for marginal trades. It's not an accurate valuation of the company at all. And we need to keep our heads, not do anything stupid. And actually, the market's throwing fabulous buying opportunities at us. So I think it's a really good time to be deploying cash. But if you're a trader, then obviously you would have sold by now anyway, wouldn't you? And you're sitting on the sidelines waiting for a chart pattern to go back in. So it depends entirely how people are, what their approach is. But I think the main thing is don't panic and do anything stupid, because you'll just make things worse, in my opinion. So over to you, Paul. I think we're peas and pod.
Yeah, you're exactly right. I mean, markets, invariably hate uncertainty and overreact to the downside, particularly in the most risky assets, which is small cap. So this is just a logical outcome of any type of volatility. We saw it obviously during the pandemic when all the small caps sold off, the great financial crisis, and you and I are long in the tooth to have known it from the dot-com crash back in March in fact 25 years to the day almost, when it started sort of going south. So we've seen this play out many times before, and I'm with you. You've just got to live through it and things will change. And just to be on the positive side, there will be positive catalysts which will come through. I mean, who knows? But I'm pretty certain there's going to be a ceasefire in Ukraine. It may not be something that Zelensky wants, in particularly what he's after, or what Europe. But I'm pretty sure the European nations want a ceasefire. Obviously, Trump has put his badge on it, his name on a ceasefire. So if that happens, then that's going to improve sort of the total global, economy. And then we're going to get deregulation, particularly in the financials, in the banks, and probably in the States, we're going to see tax cuts as well. What we're going to have in the UK, I don't know. We've got the 26th of March mini budget. But when you put it all together, there's a lot of good stuff potentially happening later in the year. We just got to sort of like get through this extremely painful period.
Well, the other thing, no, I agree with all of that. And also you had big news in Germany from a 900 billion euro borrowing and spending package for armaments and infrastructure. Well, that's got to be boosting the German economy, hasn't it? And you've got quite a few of the big UK listed staffing groups have what they call DACH, don't they? Germany, Austria, Czechoslovakia as their biggest markets. So that could be, so there could be interesting angles on this. Also, zooming out on the US indices charts, this correction that we're seeing at the moment is completely normal. It's, for example, it's actually smaller than the correction we had in July last year. Yeah. So I think this is not, a market crash. This is a fairly normal market correction. I did see, though, that in the US, the Russell 2000 small caps index is down about 16% just in a few months. And the big tech, the NASDAQ, is down over 10% from recent highs. So this is certainly not pain that's being... We've had the pain for 3 years in UK small caps. I'd say we're actually faring relatively okay compared with all the... So maybe that'll make people start looking again at UK small caps and think, well, US big tech wasn't the one-way bet we thought it was. Tesla's almost halved. Nvidia's come off by a third almost from its recent peaks. So this could, in a roundabout way, actually bring some money back maybe into UK small caps, where you can quite routinely get dividends, safe dividends of 6 to 9 or even 10%.
Yeah, no, I would agree. And also the other big anniversary, I was just thinking about it actually, it's 5 years since the bottom of the pandemic, the COVID pandemic. So I can remember my portfolio going down by 10% each day in sort of late February, early March. So this one is just like this is okay. It's everybody's suffering. Don't get me. If anybody's if somebody's on their own, don't believe you're the only person who's going through a bad period.
Right.
Everybody's. Both of us are. That's for sure. But we've been through it before, and have a look at your rolling 5 years. If you've measured your performance from the bottom of March 2020 to now March, then I bet you've made some good returns on an annualized basis, because that means you don't want to sell at the bottom when everybody else is distressed selling.
Yes, exactly. And panic selling, when you just think, I can't take any more pain, you're probably very near the low in the market. That's what I've got. But this is a walk in the park compared with 2008. And as you say, the March 2000 crash. So, if people can't cope with the normal volatility of equity markets, they need to reassess their risk tolerance and maybe put some money into cash savings or other things and have a smaller equity element, because you've got to accept the volatility when you're in equities.
Yeah, and things can change very quickly. And I'll just let's move on to one stock that I know you own, which is Warehouse REIT, which I think earlier this week suddenly got a takeover bid from Blackstone. So fill us in on all the details and what you're planning to do.
Yes, well, that was it's lovely when a plan comes together, isn't it? Because I've been mentioning now for a few months that Warehouse REIT looked a sitting duck for a takeover bid, as with almost all of the REITs in the UK. They're all significantly underpriced. It's a rich hunting ground because of market dislocation. These REITs are trading at quite routinely discounts to NAV of between 20 and 50%. And the NAVs are good. They've been already written down for the higher interest rates and so on. So there are rich pickings in this area. And myself and other commentators even said, look, Blackstone have been buying up warehouse assets. That's been in the press, obviously the huge US fund group. I normally get BlackRock and Blackstone muddled up. So if I say the wrong one, you know what I mean. So basically, and then, yes, sure enough, they popped up and said, we want to buy it. They went over the heads of management, who have rejected 4 takeover bids, which means something's got to be done about the UK disclosure rules. It's just created a false market in these shares now for 2 months at least, that management were quietly batting away takeover bids at £1.09p, slightly below, if you take out the dividend, which we were going to get anyway. And when the shares were trading about 80p, it can't be right that a credible bid approach like that is kept secret. So, but that's my only complaint. The NAV is £1.27, so I think there's a good chance this bid could be sweetened. I think something probably between 115 and 120 would do the deal. I think it's obviously an incredibly credible buyer who measure their funds under management in the trillions, I think. So this is loose change to them. I'm not selling any personally. I'm happy to sit there. And if the bid falls through, it might drop to 85, 90p maybe. But I still get a 7 or 8% dividend yield. So it's a lovely situation, this one.
In terms of the sort of like the strategy though for dealing with bids, you gave me a hard time when I decided not to sell my equal shares and go half in the market, because you were suggesting you go 50-50. So you've decided.
Oh, no, I wasn't telling you what to do in any shape or form, Paul. No, I didn't give you a hard time.
You did. You gave me a kick in.
No, I was just saying, look, if I had squillions on one thing, I wouldn't wait for the last 2 or 3p personally. But look, it's your money, so you decide. Has that gone through yet, Paul? Equals?
No, it's coming. I think it's sometime late April we'll get the money. But I did get just got some money today actually from what was it basically from the maturity of my gilts. So I'm going to put that to work over the next on some. So I've got some extra cash, which is good.
Yeah, well, there
And
are
I've,
so many. Well, that's a lucky timing because you've got bargains galore in small and mid caps, haven't you?
yeah, well, I'll tell you one I've bought later on because I redeployed the Roche. I sold when I told you 2 weeks ago, I just sold Roche. I've redeployed that funds. But just before we get into that sort of detail and stuff, there's another bid offer, which is all one in a special situation, which I know you own, Rue, which is the sort of like the foreign currency or currency printer, and also got a authentication division as well. How do you see this one in terms of go forward?
Well, I'm really bullish on this one because I think that the sale of the there was an update, excuse me, this week, I think, confirming the most important bit for me was that it confirmed that the sale of the authentication division is going ahead. And that it was going to complete in the first half of this calendar year, because that's a complex unbundling situation. But the price that they've sold the authentication division for is phenomenal. It's a huge price, and it's going to wipe out all the net debt, take it to net cash, plus give them 30 million to bung into the pension fund, and leave them in a sitting pretty. The remaining division at De La Rue is banknote printing, which I think they're one of the world leaders in this very, very niche activity. Well, that bit's up for sale as well. And they also confirmed this week that they're in a formal sales process and that they're in ongoing talks with a number of parties. So this could be really interesting, but it does contain it's less risk now, I think, that the sale might fall through. That was my main worry, because the bank facilities expire on 1st of July. But even in the worst case scenario, the bank are not going to foreclose on them, are they? They'll just extend for whatever. But that seems a remote opportunity, but I can't access any broker notes, so I'm not entirely sure about risk reward on this. Oh, and Eddie Truell has been sniffing around it and wants to buy it for £1. Was it £1.25? He's already offered.
Yeah.
And as somebody pointed out to me, if Eddie Truell wants it for £1.25, that means it's worth £2 plus. And and I think it's such a niche specialist asset, the banknote printing stuff. That type of business, would only come up for sale once in a blue moon, wouldn't it? And the regulators would be all over it to stop it if they didn't want, somebody dodgy buying it. So I think it's very interesting, this situation. Well, have you looked at it, Paul?
Yeah, no, I was just trying to do some of the parts on it, and I've got it written down. Whether it's true or not, is the authentication division has got is it £300 million offer for it from?
Is it 200? I can't remember. I haven't looked at the numbers for a while.
I've got it 300 from Crane NXT. Yeah, so I was just telling you. So basically, you add the 90 million of debt to the enterprise value at the current price, you get 330. So basically, if they get 300, admittedly they'll probably have to pay some tax. Let's just say they get net sort of 270 or something like that. So that would basically, so you got, let's say 270, and then that I don't know what's their pension deficit? Do they have to make any pension?
Yeah, it's 60 million, and that's on the actuarial basis, the prudent basis. So they're going to put 30 million in immediately from the sale proceeds, which will leave a residual pension deficit of 30 million to be paid, over X number of years. So small beer, really. Yeah.
So worst case, they've got 200 million there, and then I'd add on to the in total. So I'd add on then a one-time sales for De La Rue, because it's a 10% EBIT margin type business, and it looks as though it's growing from its trading update. So that's 250. So I get an enterprise value of about 450 versus an enterprise, effectively some of the parts of 450 versus an enterprise value of 330. So that's a good sort of like 50% upside from here.
Yeah, that's sort of the figure that I had locked in my mind. Although, like I say, I'm a bit rusty on the numbers. The other thing was the most recent trading update said very bullish stuff about the currency division, saying that is really trading well. The order book's big and growing rapidly. But the market strangely doesn't seem that interested in this. Although looking at the chart there, it is in a nice uptrend. During all this recent market turmoil, it stayed solid at around, it's still been creeping up, as your chart shows. So I'm quietly optimistic about this.
Yeah, no, I would agree.
I do have a medium-sized position in it for me.
Well done. That's good. Okay, let's. Anybody wants to ask any questions, please put them into the chat bot, and I'll put them to Paul. We got one from where is it? I just saw one. Yes, Paul the Parrot. He's asking about Spire Healthcare, which came out with a bit of a negative trading update, guidance anyway, for this current year for 2025. It's basically the UK's largest hospital healthcare, private healthcare business that has three major revenue streams, which are self-pay individuals. We've got private healthcare and the NHS, who've all paid for their sort of hips and knee surgeries and stuff like this. How did you see their results?
Well, I was quite negative on this one last time I looked at it in the autumn last year, in about October, because there were various aspects of it the numbers I didn't like. So, but then I heard I think your latest interview and a previous one you've done with Christopher Mills, obviously at Harwood, and he more or less made this his favourite share for this year. So I thought I must look at that. So I was absolutely staggered when I saw that the shares yesterday were down about, I think at one point, about 25% on their 2024 results. So I openly admit I'm absolutely not an expert on this sector at all. It's much more your sort of thing. But I unpicked it all, and it was basically a profit warning, which if you feed it through from they like to quote operating or EBITDA and operating profit, but it's meaningless because there's so much finance costs and depreciation charges that even adjusted PBT is only 50 million. Yes. So I think this share highlight, and the adjusted EBITDA was 260, adjusted PBT was 50 million. So this share, I think, is a very good case study for questioning whether all this valuation on EBITDA multiples makes sense, which, as you know, I'm a bit skeptical on. But that's how the whole M&A world works. It's how the whole banking world works. But this one's a great example of how actually it may not be as good as it's cracked up to be. So I'm not a fan of Spire Healthcare. I don't think it's a very good business. It's only making a PBT margin of 3%, which is pretty poor. The balance sheet's not got that much on it. The debt is covered by freehold property, so that was okay. I can't get above amber on it at best. So yeah, I just don't know why. I mean, the bull story is a good one, isn't it? That they can perform better in future if they get more work from the NHS and all of that. But also the bulls said, oh, it can just pass on cost rises to the customers. Well, it now transpires from yesterday's RNS that it can't. It's only been able to pass through some of these additional costs. And a lot of us were asking, well, hang on, why have we just had a profit warning? Because they've got higher wages costs because of national minimum wage and national insurance. We've known about that since October. So, which does raise the question why they didn't apparently budget for this. So, yeah, I think this is a bit of a clanger, actually, that's really put me off Spire. Anyway, I'll stop waffling and over to you, Paul.
Yeah, I mean, all I would say is that in terms of the employee cost being able to pass them on, that was definitely the bull thesis for the actual company, and they haven't been able to. They've had to absorb 20 million, but it's actually not so much not being able to pass it on. It's actually more the mix, because what you've got is because they're doing so much for the NHS and self-pay people have decided, right, I actually do want long-term private healthcare. So there's a shift from self-pay customers who are much higher margin into either NHS, they're going on the NHS because they're shifting the waiting lists, or into private healthcare, which again is big volume and lower margin.
They squeeze the margins, do they, the big buyers?
Yes. So in other words, it isn't. They would have been able to pass most of it, if not all of it, on. But the problem is it's the mix which is actually doing the damage. It's not actually not being able to pass it on. And if you have a look at the balance sheet, which I'm sure you did, what's really interesting is that the freehold property is valued, I believe, at something like 700 million, 800 million.
Just under 689, I think.
Yeah, but in that note where it talks about the value, the market value of that leasehold properties, it's 1.4 billion.
Freehold.
So where you said
freehold.
Sorry, leasehold. Yeah, the leasehold is, sorry, correct. Thanks for that. Yeah, no, it was 1.4 billion. So you get an uplift of over 500 million. And if you put that through the net tangible assets, you get to over £2 per net tangible asset per share. So
where are you getting that figure? Because couldn't they just revalue the freeholds and bring the balance sheet up that way?
They could, but they haven't done. They've just basically put it as a separate note. It's in that fixed asset note anyway, the freehold property.
Oh, okay, I'll have a look at that. So yeah, 649 million of freehold property. So you're saying there's substantial upside on that. Okay, yeah.
So, well, that's what the accounts say, 1.4. So if you do it on a sum of the parts, and you basically say, okay, if somebody wanted to buy this, they would sell the assets, the hospitals, to a infrastructure provider, and then sell the operating business to
that's an interesting angle on it. Yeah,
because you get big money basically for the assets, no doubt about it. Who would just do a sell and lease back essentially.
Yeah, so that could be an interesting special situation on that basis, couldn't it? Yeah, but the trouble is, it doesn't matter what you value the freeholds at, the company's generating negligible return from the assets. That's my problem with it.
Well, if you look at it on the adjusted basis, you've got a 10% EBIT margin, which should be able to increase through efficiency savings going forward. But I thought,
but the PBT margins are 3%, and that's taking into account all the costs. So I just think these EBIT margins are a fantasy, to be honest. But
but in that, in the PBT, we don't want to get too technical here, but you do have obviously the depreciation of all those capitalized leases. And that's not a cash cost. Yes, you have the rent you have to pay on the capitalized leases, but essentially
the rents are split now, aren't they, into depreciation charges and finance charges? But they're not that much different to the cash rents. That's my understanding of it. So and the adjusted PBT of 50 million obviously has stripped out all the has ignored the intangibles amortization as well. So to me, adjusted PBT is actually a pretty clean number. Personally, but it's different people look at the numbers differently, don't they? That's what makes a market, I guess.
Yeah, no, you're right. Yeah, no, good. Okay, let's go to another company that's very popular with shareholders and some rock star investors like Richard Stavely likes it, Capita, which is this sort of the outsourcing business that had its day about 20 years ago and then's been looking like a ski slope since. It's trying to go through a turnaround, deleverage. But it's a lot of it. I think it's got negative net tangible assets on its balance sheet. Margins up EBIT of about 4%. Management's target to get to sort of 6 to 8%. But you do have headwinds coming in from the government at the moment in terms of knocking all the consultants. Anyway, how do you see Capita? Because it's very, very cheap.
Let's do it the other way around, Paul, and you carry on and say what you think of it, and I'll come in second, maybe.
Well, all I would say is that. All I would say is it's a low margin contracting business that does about 50% of it in call centers, which must have a secular decline with AI. However, it does have some neat software and computing technology in its businesses. As per, it made a big sale just recently, which cleared off a lot of its debts. If it can grow, it gets cash up front. And therefore, it will solve its deleveraging. As it shrinks, because it's got negative working capital, then unfortunately, it's going to suck in. It's going to increase, which is what happened last year. It all comes down to growth in a high competitive. Outsourcing is now a very competitive industry, full stop. So it needs to find something that can get that margins and get that top line going. And frankly, it's above my health grade or my pay grade to be able to identify, is this going to be a winner in a challenging market? Because the bar's very low, but we have seen this movie before. Just look at Galliford Try, which is a contractor in the civil areas, and its shares have six bagged, I think, in the last 3 or 4 years. So I'm pushing the ball back over to you, Paul. What's your thought?
Well, I had sloping shoulders on this one, and I delegated it to my co-writer Dave, who
good man. Okay.
He said to me, you utter bleep, bleep, bleep. He said, I looked at this one in 2018 and spent a whole weekend on it and couldn't unfathom it. But anyway, Dave had a really good stab at covering the key points. This was on 5th of March. That was Wednesday this week, wasn't it? It was its results for 12/24. I had a look at the figures as well. It's so complex. The trouble is, they've got all these different activities buried within Capita Group. And it's like, when they did this deal last year, I think it was, to sell off some of the software companies to Vin Maria at ADVT, they got sort of over 200 million for them. And quite a lot of people were saying, I didn't know they had those. So there could be all sorts of things buried down the sofa with Capita. And massive adjustments. It's been a turnaround now for 5-6 years or something ludicrous like that. But the adjusted PBT did rise. It was up 22% to 50 million. I think that was ahead of forecasts. And it says it expects to be cash flow positive at the end of 2025, this year. Nothing available from brokers. And the net financial debt is only 66 million. But as you, again, as always correctly say, the balance sheet is still heavily negative because it benefits from customers paying it up front. And it's letting go unprofitable contracts, which unfortunately has a negative cash flow impact. So we decided it's too complicated. But having said that, at 13p, you're getting a hell of a lot of business for the money, aren't you? So we, Dave and I, both decided to be a little bit speculative on this one and give it an amber green, which is a sort of 4-star rating, saying we think this could be an interesting little punt at 13 or 14p. But do we have any particular insights on how it's going to end up in years to come? Absolutely not. It's too complicated.
Yeah. I think the big danger for the recovery or for the turnaround is the government spend, the budgetary cuts. Just wait until, if I was going to buy it, I'd wait until the 26th and just see what she's going to, Rachel Reeves is going to do to benefits, because these guys do a bit of benefits and they also do other government. And I've just got a sneaky suspicion she's got no choice now. She's going to start nailing consultants' budgets. We've already seen that through the high-level area with Deloitte's and Anderson, Arthur Anderson's and all that kind of KPMG. At the lower level outsourcing, it's going to happen as well. So I'll just, I don't know. I mean,
it depends how efficient they are. And I always get the impression with Capita that it seems to have made so many balls ups over the years that it doesn't scream at me that this is a super efficient business, layers and layers of management, and they talk about AI, but is it real or is it? It's just too difficult to judge, isn't it? But I can't help thinking at 218 million market cap, this is the sort of thing the trader in me would say, go on, Paul, have a little punt on it and see what happens,
Yeah. No, I would agree. It just, obviously it's been a widow maker for the last 20 years. So it's a big call, that one. Now we've got a question from Ben Sharman. He's asking what your latest thoughts are on Hunting, who came out with some good results, I believe, just recently. A little disposal as well. Anyway, what's your sort of thought? Very cheap, actually.
Very cheap. I've got to disclose I hold Hunting personally. And rather embarrassingly, I haven't got around to properly looking through the results which came out yesterday. I just got swamped with everything else. So it's sort of work in progress in my WIP tray. Obviously, I think it's a really interesting engineering business, mostly oil and gas sector focused. So with the low oil price, it just tends to track that down. But the figures were good. I think the adjusted PBT was up 50%. I haven't got my notes to hand, but was it interim results or full year, Paul? I think it was interim.
I can't remember. But it was definitely some good results. I mean, they trade at less than 10 times PE.
Yeah, it's around about that level. Now, the one of the standout features of, here we are, 3rd of March. Oh, no, that was a disposal. They did a small disposal of $12 million. And they're basically saying, well, not basically, in all the management communications, they're telling us we've got a bulletproof balance sheet, which they do. The balance sheet is incredible at Hunting. So it has a colossal, and I'm talking hundreds of millions of firepower for acquisitions. And they've said the market cap's nearly 500 million. I think they've got capacity to do maybe 250 million acquisitions. And management have basically said repeatedly on webinars, we've got a whole bunch of things lined up for acquisitions. And I think that wasn't one announced today, actually, or yesterday.
Yes, according to Ben, there was one. Yeah, small one, he said.
It's come back into my head. It was an IP purchase. This was announced this morning, I think, or yesterday. I didn't get around to writing about it, but it's coming back to me. It was IP for extracting more life from wells in some cost-efficient way of making depleting. And it sounds like they're already selling it in the North Sea, but they've just bought the global rights for it, and together with they'll have to pay a 15% royalty to the vendors. So this sounds very interesting. Admittedly, sort of a bit jam tomorrow-ish type technology, but as I say, I think the acquisition side of it is looking quite exciting. Management come across very well in webinars. They've got a lot of interesting They've got about 4 divisions Hunting have, which are some very interesting products in there. You know this one quite well, don't you, Paul? So yeah, I like it. I'm bullish on it. I think it's very good. So,
I think the hard bit is trying to understand what the beta is to the oil price. If the oil price comes, if we do have a ceasefire in Ukraine, then you can guarantee 2 things. Russia is going to pump like anything to basically get more money, and they're going to try and get the sanctions off their oil, etc. So you've got Saudi Arabia, who's going to protect their onshore business as well, and you've got America, who's obviously opening up all the licensing and the permits to go and drill out in the States. So there's going to be a lot more supply coming on. Plus, you've got a lot of non-OPEC supply already coming on in the marine. And I think these guys should do better in North America, which they're heavy into, but may do less well in the marine side of the oil and gas. And the reason why I say that is because if the oil price goes down, it makes it less economical to take it out of deep water, because that's more expensive. You find it goes to the cheapest place. But I think you've already got that in the price. I mean, when you look at it, 9 times 8, so 9 or 10 times PE, superb balance sheet, and good technology. I mean, there's a lot of bad news already priced into it, I would say.
Yeah, it is. It's 0.7 times tangible book value, the valuation. Yeah. Incredible. Yeah. And, if you look at the progression of profits, it's been very good in the last 2 or 3 years. They won some very large contracts in, was it Kuwait? I'm thinking Kuwait, something like that.
Yes, that's right. Yeah, Kuwaiti. Yeah, you're right. I remember
really
that.
Super bullish, saying, look, we've got lots of exciting stuff going on in there. Mind you, the head guy is American. And I mean, Americans are an excitable group of people, aren't they?
No, they're not. I mean, Donald Trump's pretty quiet. and JD Vance's. Okay, we got. Let's move. Let's change tack. We've got another question. LaTJ09. He's asking about. We haven't covered it for some time. Gaming Realms, which is basically the software provider, licenses out Slingo, which is a combination between a online slots game and a bingo game. Very, very successful. How do you see this one?
We had an update. You'll be really impressed here, Paul. I won't say don't know today, because I've updated my spreadsheet to bang up to date.
Oh, well done. Fantastic.
First time ever. Trading update came out from Gaming Realms on the 4th of February. GMR, 108 million market cap. It was in line with expectations update, which you tend to get with this. It seems to have pretty reliable repeating and recurring revenues. Very good growth. Adjusted EBITDA, £13 million, up 30%. I'm pretty sure all of that's organic as well. It's a very good organic growth story. Yes. Gaming Realms is, and Canaccord didn't change the forecast. It's got a goodish balance sheet, but it's a capital light business because it just basically needs a few computers and desks and things, and that's it. There's no inventories, of course, hardly any fixed assets. So therefore, it doesn't need much on the balance sheet, but it's got a £10 million cash pile, which it's built up organically. It's got a very, very good track record, this share, but everybody ignores it. Never seems to go anywhere. I don't understand why Gaming Realms is so out of favor with investors. It looks, I don't hold any personally, but I always write positively about it, and the share price goes nowhere. So despite all the graphs going like that, the revenue and profit, don't understand why. Have you got any insights on it, Paul?
Yeah, I mean, I think for a gambling type business, you're always going to get a low multiple, particularly a company with such a dependence on one particular core product. And what will happen going forward? Well, we do know in the States they'll start rolling out more of the iGaming, which is the iCasino games, which is what these fall into gambling into the 51 states in the US. I think there's only about 8 at the moment to get in line with the sportsbook. So that will happen, but I mean that you'd have to guess what Trump. Basically, does he like gambling? And if he does like gambling, then he's not going to tax baby tax, but actually he could tax baby tax this. And I've just got a sneak suspicion Rachel Reeves is going to basically nail, because when we went to the October budget, that was a big surprise that she didn't increase the gross gambling.
Yes, you're right. I remember that.
I've got sneak suspicions. I mean, the reason why it's a low multiple is simply because of the regulatory overhang, because it's one of those products that is deemed as a vice, and therefore if the government want to dip into the tax, they'll just raise it if it's doing well. So you lose some of the upside by that side. But I'm with you, the actual fundamentals, the growth, the margins, and the scalability of it is fab.
It is, yeah. I've just been trying to find the geographic split while you're talking. I've just found it. This is on ShareScope. It's got a breakdown of the activity. America is half of the revenue.
Yeah, okay. Yes.
Gibraltar is 18%. So I don't know what that is. Well, the gaming companies are based. A lot of them are based there, aren't they? Malta,
yes, they are.
Malta, 16%. So yeah, that would be not where the end customers are. It's where the casino customers are. So I mean, the thing is, though, put a pull forward PE on it is now I've got 14 times, which for something growing organically at something like compound 30% per annum or something seems incredibly cheap. But I do take on board the points you made. It's probably not going to get onto a particularly, but it is basically a software business. It's not a gambling company as such. Its customers are gambling companies. So very cheap.
No, I know, yeah. If it gets bought by somebody else, then that's the best place. You need a portfolio of these rather than just have one stock.
Yeah, this would come up for a private equity type buyer, wouldn't it? Because you couldn't have an industry buyer buying it, because the competition would then stop buying from it, wouldn't they?
You're right.
I think management have decent holdings here as well, I think.
Yeah. Okay, let's move to another sector, but this time media. Let's go to ITV, the broadcast terrestrial telly channel. Three big parts to it. Obviously, the broadcaster where it does the gets advertising revenues. It's got ITVX, which is effectively its iPlayer equivalent that seems to be doing very well, and then obviously the studios, which it sells programs or creates programs for both itself and for third parties. You own it, I understand. So give us the investment thesis.
Well, it's not a big position, but it's in my sort of medium-term trading account. I was just attracted mainly to it. It caught my eye last year, I think about a year ago, when ITV announced that their pension deficit, which had been or still is, a large pension fund, was now fully financed and there was no further liabilities. And I thought, well, that's interesting, because so why is it on a PE of 7? Because normally a PE of 7 for a larger business implies that there's some big problem with debt or with pension deficits, but there's neither at ITV. And the current forecast PE ratio works out at 7.2. The dividend yield is nearly the same. It's almost 7% divvies. They've done buybacks when they sold a stake in something to do with the BBC, didn't they? They had a part share in some streaming service, I think. So that was a bit of a one-off. Anyway, I looked through its results first thing yesterday morning, and I thought, I'm no expert on this sector or this company. I'm just really an armchair sort of numbers man, really. And I thought, this looks very good. Yes, yesterday, 6th of March. So adjusted EPS was up 23% to 9.6p. And the shares are about 75p. So you can see there, that's a PE of about 8, isn't it? Bullish commentary, although they're very, very vague at ITV with their trading updates. Their investor communications is terrible, which for a communications company is pretty rubbish, isn't it? Balance sheet's all right. Covenant debt is only 0.6 times. So you've got a very low PE, generous dividends, pretty rosy outlook at ITV. What's not to like? I think it's the wrong price. And there's also bid or breakup talk. With Sky News even mentioning the suitors who are believed to be talking to it. So I think a very nice each way bet, this one, ITV. So any I mean,
look at all the metrics. I mean, you're right, it's absolutely dead cheap. The only thing which has put me off ITV is, where's the growth coming from?
Well, streaming. It's doing well in streaming. And the TV show making side of it, the studio side of it is doing well, I believe. I think people just look at it and think, oh, it's just terrestrial broadcasting. But it's actually not. It's got these other growth areas within it.
Yeah, no, if it can more than offset, if that broadcasting linear television business doesn't go into terminal decline, which is, I think, it must be at least a third, if not half of it still, its
I'm not
revenues.
sure. I can't remember off the top of
But
my head.
that's the only thing. If you can start turning that top line into sort of mid to high single digit top line growth, then you'll get good fall through. But remember, it's competing against the likes of the big media producers. You've got never mind sort of Google with YouTube, but it's got all the big production houses. Anyway, all I would say is that it's dead cheap, and there's a lot of bad news. So it only needs some good news to really start getting motoring, and a takeover would do that.
And it's holding its own. I mean, this is the thing. We're not talking about a declining business here. The profits were up significantly for calendar 2024. So I think maybe the market perception is maybe too gloomy on it, I think. So I'm not going to hold it forever. But if it got to if ITV went up to, say, a PE of 12 or something, or if it got a bid approach, then I'd cash my 50% gain and walk away,
Yeah, no, I'd agree. Yeah. Right. We've got a couple of questions. Well, a couple of people are asking about the same stock. We've got AA31. He's asking about Zotefoams, as well as Chris Beaumont Dark, who's, I think, as I understand, is a professional investor. So any thoughts on your latest? Do you still own Zotefoams, by the way, Paul?
Yeah, of course. Yeah. No,
okay, right. Well, what's the score? Why is it turning into a ski slope at the moment?
I don't know, because more people are selling than buying.
I've had plenty of that.
Yeah, it's relentless. It's pretty much every day on this one.
Anything to worry? Anything to think? Anything to worry about?
Well, the trouble is, when people see a share price like that, they start inventing things. So they start putting reasons around what the share price is doing, and it could be something very simple, like IHT managed portfolios might hold it, and they might just be selling because the customers are taking the money out. And which won't show up on the RNS because, of course, they're individual client accounts. They're not aggregated. So that's one possibility. Oh no, I might be talking rubbish because it might be fully listed. I think that was nonsense. Let me just check. ZTF, isn't it the ticker? I might have to rewind and edit that bit.
I wouldn't. You're not editing. I'm sorry, but we'll just.
No, I know.
That's one to check.
I was talking rubbish. It's fully listed, so ignore that. So it remains a mystery why it's going down. The latest update from the company was 3rd of March, and I've just said on it. Oh, that was just the CFO retiring. Now that does sometimes unsettle people, but it all sounds orderly. The last broker note on Zotefoams was that I've seen was from Singers on the 23rd of January. The balance sheet's fine. It's got some debt, but that's offset by freeholds. I just think it's oversold. Oh, here we are. Yeah, I thought this. There was an ahead of expectations trading update on the 23rd of January this year.
Wow.
Ahead of expectations. And look at what the shares have done.
Yeah.
It's bizarre. I mean, look, people say, oh, the big customers, Nike, they're struggling and blah, blah, blah. But that didn't come through in the trading update. Everything sounds fine. So complete mystery to me. And I almost bought some more today, actually, but I couldn't find any money.
No, it looks crazy, that does. Okay, we got in a similar vein, we got another question from Ben Sharman. He's asking about Tracsis, which is the software hardware expert in all things rail. It just won about, I think, whilst I was away last two weeks ago, a huge pay-as-you-go contract with Network Rail to roll out to all the urban cities. This effectively the Transport for London equivalent of pay-as-you-go, tap-as-you-go type software technology over the next 3 years. They came out with a trading update last week, I can't remember what it was. The shares shot down. Anyway, they're now at like £3 according to Ben. How are you positioned on Tracsis?
I don't hold any personally, but I have just bought some for a friend who I manage an ISA for him, and I've actually just picked some up at £3.8p for his account. I mean, I'm staggered to be able to buy Tracsis at £3.8. I mean, I think it's more than a 10-year low. Yes. And the news from the company hasn't been particularly bad. I think they did fluff their communications a bit on this. We had two announcements recently. 19th of February, this was the major contract win, and it shot up 18% to £4.25 because it seemed to be including what sounded like an inline trading update within the announcement. But it kind of, as one of my readers pointed out later, it wasn't quite an inline with. It was one of those things where it had been PR'd a bit, I think, and we were kind of. I think a few people are feeling a little bit misled by the wording of that update on the 19th of February, which didn't go down well. It's got 20 million in cash, although a lot of that is upfront payments from customers. It did rebound, as I thought it would on the 19th of February, but it's given all of that back and had another leg down. Yeah. So, and then we got a full update on the 26th of February, a week later. I haven't copied across what that RNS said. Sorry, do you know what they said on the 26th of February, Paul? I can't remember.
Yeah, they basically said they were still in line, but they had some, this is for the July year end, and they didn't actually give any indication for the following year. But they were obviously very happy in terms of the rollout of that tap and go, which could be transformational longer term. So,
although it's starting small, isn't it? The tap and go thing.
Yeah. But it could be huge. I mean, it now trades with. It's got 22 million of cash. It now trades at just over 10 times PE. So if you strip out the cash, it's less than 10 times. I mean, this looks like a takeout candidate to me.
Could be, yeah. I mean, it looks extraordinarily cheap. I mean, the market is pricing in something going horribly wrong, isn't it? There, because...
to tell you what I think it's pricing in. Okay.
Yeah, go on.
It's pricing in a distressed seller. Somebody's got the wrong side of this and is dumping stock on it. And the reason why I know that is because I took the other side of it this week, and I was stunned that I could buy so much stock so easily, which is either a sign that I'm an idiot, or it's a sign, which definitely could be true, or it's a sign that somebody wanted to offload a big chunk. And so I took all of my Roche proceeds from last week, and so I've got now full position in Tracsis at a higher price. But I was just delighted that I got I never thought I'd be able to get the liquidity, and I did. So I've got a full position now because I'm with you. I just think I just don't think it looks as though there's too much bad news, which is currently priced into the stock. And I'm prepared to take a 3 to 5 year view, and I believe that pay and tap and go contract is transformational for the business, because they can then use the same technology abroad in different locations, Europe or the States, etc. And once you've won that contract, you're the go-to player. I've got a sneak suspicion they'll win the tap and go for the Great British Railways, all those franchises. They haven't been able to put that contract out. It's simply because, basically they haven't created Great British Railways. But in 2 to 3 years' time, I mean, who are you going to go to? You're going to go to somebody who's already put that technology in all the urban railways and therefore can do that system for all your franchisees, or are you going to go with somebody else who's going to have to put in the same infrastructure and you have to pay for it? I mean, it's a no-brainer, basically. So
interesting. Oh, well, that's very good news that you've taken a chunk of it. But yeah, like you say, the fact that you were able to buy in size, it definitely tells us there's a seller, doesn't it?
Yeah. No, I was very surprised. So anyway, I've gone in big boots on it. Well, I should say big boots, but I've got full position anyway, which I was very, very happy to take. But I'm obviously nursing a big, at least a 10-15% loss already. So
it won't matter in the long term. I think this is a good quality business. I've just found my notes as well. It said the H1 is basically quite poor. That would be to January, wouldn't it?
Yes.
So it had a soft H1, but it gave quite credible reasons for this. £1 million impact from Network Rail funding issue, which they say was previously signposted. And they give quite credible reasons for saying why H2 should be better. So people don't like H2 weightings, do they? But I think, again, this sounds, well, from what you've just said, the share price is all about a big holder dumping the stock, isn't it? It's not.
It's somebody's just taking it as liquid, getting some liquidity needs it. I mean, why you sell at a quality business with software and good gross margins at these levels is because you're desperate, basically.
Yes. And mind you, I've said here, it says we're hoping to hit full year market expectations, but it's only sort of, is the way I phrased it. So I think there's a chance of a profit warning later this year. That was my overall view on Tracsis, but I think the share has fallen so much. I think it's already priced in and then some.
Yeah, and it's still going to be profitable. And if it goes through some tough periods, he's got a rock solid balance. He's got 20 million of cash. I mean, you can get through it. What you're betting on is in 3 to 5 years, is this going to be a broken ship, or is this going to be a motoring train? And I'm betting on the latter. And if it's on the latter, it's going back to 8 or 9 quid in 3 years' time. But hey, it's one of those things you have to take a view. What's going forward?
Definitely. I think we're in agreement on this. I think looking through this current chaotic period, I think I could see Tracsis maybe at 6 quid. I think I'm more modest with my aspirations, but I think it's almost certainly oversold at 3 quid.
Yeah. Now I have to congratulate you and thank you for your interview this week with Chris Gillespie of H&T, because I listened to it in full yesterday and must admit, Paul, you were fabulous and he was great. So I learned a lot. Now, please, could you just take us through top level what you learned? Because I learned a lot on it about that sort of thing. And they're the number one UK pawnbroker. Valuation is just perplexingly low.
It is.
So what did you come away? What are the sort of the key takeaways from it?
Yeah, I was very pleased with it. He's a really easy Chris Gillespie. I've not spoken to him before, but I with my CEO interviews, I only do a few of them, and I approach the companies. I say, look, I think this is an interesting company. I'd like to talk to you in my capacity as a private investor. I don't actually own any H&T shares. I never charge a fee because I want to be completely independent. And it's basically like how I would talk to the company if I was just having a private phone call with the CEO, just learning more about the business, and I record them with their consent and put them out. And it's been very well received, this interview, because I think one-to-one on a podcast, CEOs are more relaxed, aren't they? Compared with, he just talked us through all the aspects of the business, and I was interjecting with questions. So why I like H&T? Well, it's a specialist lender. But it doesn't have any of the bad debt risk that banks and all other types of lenders have, because they're very small. Average £200 is the customer loan, secured on an item of jewellery or a watch that's given as security. They charge between 2.5% and 10% per month, so it's expensive, but very short-term lending for immediate financial crises. He's saying there's no regulatory issues or threats with it, because the regulators, have regulated a lot of the competition out of business, like the payday loan companies, and pawnbroking is seen as a positive, well-regulated activity. Not everyone agrees with that. Some people see it as, preying on the poor and so on, but there are it's not just poor people who use pawnbrokers. He was saying lending to businesses, business owners who can't meet their VAT bill or something and just need to take their Rolex in and borrow £5,000 against it and meet some urgent liabilities, and then go and get it 10 days later and take it back. So, and it's much more mainstream, Chris Gillespie was saying, in other countries. In Britain, we have this sniffy attitude towards pawnbrokers, but it's up to each individual listening to this to decide whether or not you agree with that. But the numbers, forecast PE is only 7.4 times. The business is doing well. The forecast yield is 5%. You've got a rock solid balance sheet. This is the other thing I like about it. Your price to net tangible asset value is only 1.1 times. So it's fully tangibly asset backed almost. And Chris was saying, the CEO was saying, he's not going to take any risks with the balance sheet. He said, we have a bulk loan with whoever it is, the banking syndicate or whatever, but it's only about a third, if that, I think, of the pledge book. So he says we're not going to stretch the lending multiples. It was if anybody's got an hour and they want sort of a nice briefing on this company, and because I'm not charging, I can ask them anything I want. So it wasn't soft questioning. It was me just saying, look, what about this? What about that? And I asked him directly about the ethics of it. And so I think, I was pleased with it. I think it was a useful thing, hopefully, for the investor community.
No, it is. I mean, I'm a paying subscriber, and I would say to anyone, I'd say to anyone, sign up. There's only 100 quid, 120 quid per year to sign up to Paul Scott's Substack, and it's fab. And the amount of content you get keeps me informed. I mean, I listen to the podcast every single day and have a good chuckle, simply because it updates me on all the small caps that I've not covered. So I find it absolutely fabulous. And the interview, And genuinely, the interview with Chris was really, really helpful. The one thing which I didn't appreciate was the term, how short actually the lending was.
Yes.
And what that
Three
meant
months on average, yeah.
and what that meant to me was such that what is the visibility of that pledge book in terms of, because it rolls off every 3 to 6 months and you have to renew it every 3 or 3, rather than the bank which has a 5 or a 10-year mortgage, etc. Then it rolls off. And so I can understand why the interest rates have to be so high, because essentially you've got so much admin associated with very short term leases. So that's why you've got a shop rather than online side. So
and all they don't charge any admin fees. It's just interest.
Yes.
So if you're at say a slightly stretched individual, often middle class people as well. It's not just poor people, and all your direct debits are about to bounce. You go to the pawn shop and get a couple of grand out. Yes, it's going to cost you maybe 100, 200 pounds in interest, but you're going to save 25 quid for each in bank charges for every bounce direct debit that will now be paid. So you could look at it that way. There's an opportunity cost to it, and that's coming from me. That's not what the company told me. I've just some of my friends, solicitors and office managers and things, use pawn shops every now and again. It's quite mainstream.
No, it may be impacted going forward by the buy now, pay later, where you don't get any interest, and it's short term lending, isn't it, against purchases? But I think that's mainly for people who have got a credit quality, whereas these guys obviously haven't. They're the unbanked, aren't they?
And that's different. I mean, pawnbroker is more for emergencies, isn't it? It's just you suddenly got to, or your vets the vets just landed you with a £2,000 bill for clippering your dogs. I wasn't saying anything.
Okay, let's move to one industrial that I know has piqued your interest, which we've never covered before. I've never covered it in 5 years. It's an industrial lighting, specialist lighting business. We've got FW Thorpe, ticker TFW, family business, very, very good margins, and the shares have fallen. Anyway, what's piqued your interest on the investment case?
I followed this for years, FW Thorpe, always found it to be very, very expensive. But have you got the chart up there, Paul?
Yeah, I'm just going to put it on. Yeah.
What's piqued my... So I've always been interested in it, but I've always looked at a very strong balance sheet, one of these conservatively owner-managed businesses, the family, they're, don't take any risks with it. The current price is 3 times tangible book value. And it's a decent size, 353 million market cap. It's just over £3 a share now. Now, looking at my own chart at this end, it peaked at £5 in 2021. And I think if you look back pre-COVID as well, it's always been a very highly rated share, with a PE, I think, well into the 20s. Well, it's now down to about 14. And I asked Dave, my co-writer, to have a look at this one because I thought, let's have some fresh eyes on it, because he'd never looked at it before either. And he spent a couple of hours on it, and he came away saying, yes, actually, this is really interesting. Now, this one is AIM listed. I've got to get it right this time. Now, this one I know for sure was owned, a bit like James Halstead, was owned by a lot of the IHT managed portfolios. So it had steady drip by drip buying of the share over years as they were seeing fund inflows, and I suspect they're now seeing fund outflows, and that's probably why you just have a dribble of sellers into a very illiquid share, and that's again why I think it's so low. So this one I think is worth a fresh look. So if the readers want to take a look at it, it's not a trade. This is for just as a long-term business. Very nice numbers, very good margins. The latest update on it, I think, was yesterday, wasn't it? They said in line, current trading marginally ahead of last year, which I think was the same wording they put out in the previous update. This one is, it was interim results out yesterday, so it's a June year end. Very strong balance sheet, 37 million net cash, which is 10% of the market cap. So my co-writer Dave reviewed it. He thought it was good as well. So we've marked that green. We've been green on it for ages, and it keeps going down. That makes it even more green the way we look at things when the trading updates are strong. Now, an interesting angle on it that I discovered last time was that they don't adjust out the goodwill amortization from the earnings figures, which nearly all other companies do, don't they? Your adjusted PBT. Well, FW Thorpe, it's one of those old-fashioned, family-run things where they're not trying to impress anybody. They just put the numbers out as is. So the numbers include the goodwill amortization charge, which actually means that if you were to standardize it with everyone else, the earnings would be about 10% higher.
Yeah,
and obviously
that's purchase goodwill, is it? Purchase goodwill.
Purchase goodwill, I believe so.
Okay. Yeah.
I'll have to double check that, but I'm pretty sure I would have checked that when I originally wrote that article. If I didn't, we slap legs. I don't make many mistakes, but I do make the odd one, so I can't guarantee that. But that would move the PE down from 14 to about 13, which is a nice little kicker, isn't it?
Yeah.
So quality business, I think, this one, FW Thorpe. Have a look and let us know what you think.
Yeah, I would just say the one thing, if I was before buying it, I would want to have a look at the competition. It makes very, very good margins for a specialist lighting business, 18% EBIT margins. I'll just be careful. Is there any Chinese competition coming on in this area? Because you don't know if they suddenly copy your products, and then
it's very niche. I think it's quite specialist stuff, but good point. I haven't actually drilled down into the products. Yeah.
Okay, let's look at one last one which came up with some good results. Quartix Technology, telematics systems to small, medium-sized companies.
Yes, I like this one. It's Quartix is telematics. So what it does, it puts the little boxes into the cabs of vans that tell you where to go. They've got a nice niche in this, in that they provide the products to SMEs. So it's even as much as small, it's very, very small fleets or even single van operators. And what's interesting about it is how sticky the clients are. Now, I've never even looked at the product, and obviously there's loads of competition within telematics, but the stickiness of the clients and those recurring monthly revenues tells me that the product must be good. Otherwise, they'd switch to something else, wouldn't they? So, and the history of Quartix is of very high profit margins. It makes, there hasn't been much top line growth over the years, which is why it's sort of derated from being an exciting growth tech type company down to a more sort of bog standard value, not quite value, but not far off. Because the revenue they had trouble, I think, raising the prices. I think they were under pressure to keep the pricing down. They also had a change of management. The founder retired, but it didn't work out with the new CEO. So the founder came out of retirement and has really turned this thing round now in the last year or two. And I had a chat with him about it, actually. He's very approachable. He's happy to talk to investors. And he's just done a completely back to basic strategy, stripped out the cost. The previous management made a small acquisition, which he's just ditched. He said it wasn't right for us and got rid of it. He cut the costs, focused the whole business on developing the product and getting out there and selling it. And it's so simple. When you hear him talk about the business, it's just lovely. It reminds you of how owner-managed businesses and entrepreneurs should be. And they make a whacking great fat profit margin. They make about a 20% PBT margin, and they pay it out in dividends. So it's a lovely business, I think, and the growth is now returning. He does a short presentation video on results days on Quartix's website, which are well worth a look. They're only about 12 minutes, and he puts up slides showing you, that the growth is beginning to accelerate, and they've got growth in continental Europe that is moving up a gear. So I think Quartix is looking interesting again. Not obviously cheap. It's on 18 times forward earnings, 3% yield. So I think we've missed the recent lows on that. I wouldn't personally, I wouldn't buy now. It's up at nearly £2. But down at the £1.50 level, where you can see on the chart, it's found a floor, a reliable floor. I'm wishing I bought some down there. I think people who bought at £1.50 do fine. There was an overhang here with Sanford de Land, which was the biggest shareholding over a number of years. They sold down from 19% to 9%. But I did the news filter on ShareScope, just put in Sanford, and up came all their RNSs. You can click on them all. They stopped selling in January 2024, and they haven't sold any more. And I believe they're happy long-term holders now. They've roughly halved their position. So it looks like the selling overhang has gone with Quartix, although never say never. So I don't know. I think it looks good. Yeah, it's worth keeping on the watch list. It's the sort of share I would now buy on the dips. You know, any major market sell-off and people dump some shares and it goes back to £1.50 or something, that's probably the time to be nipping in. So one for people's watch lists, I think.
Yeah, no, I would agree. One thing it's difficult for somebody like myself to understand their competitive position in that telematics space, because as you rightly said at the start, it is hugely competitive, and
It is.
how you can get pricing and is it priced down and all this sort of stuff. I mean, if Google ever decided, right, Google Maps, if we're going to do telematics off the back of it and allow industrial customers to do it for free, they just roll it all in, then that may kill it off. You know, I just don't know.
Already. I mean, taxis and things all use Google, don't they? Google Maps. So you're right, though. I should probably find out more about the product. But what the numbers are telling me is that the customers like it because they're sticky, and I think it's
no, I'd agree.
I don't think it's much. It's not, you know, a big expense, and it's just man in a van or gardeners or people like that seem to use it and like it. So, but you're right. We should probably do a bit of digging and find out more about the product. Yeah.
Brilliant. Okay, well, we've done 65 minutes, so thanks everyone for your questions. I apologize, I've just seen a lot of comments in terms of some people were struggling to get the charts on the screen to see them. Now, they were definitely there, so you should be able to see it on the recorded version, because Paul and I had them on the screen and they were definitely there, so they will have been recorded. But I don't know why people unfortunately couldn't see some of the charts.
Oh yes, I've just seen that. Yes, dear.
But they'll be on the recorded version anyway. So thanks again for your questions, everyone. Anyone's haven't answered, please hold them for next week. And thanks again for your comments, Paul. Are you still in Gozo next Friday?
Yes, I'm out. I'm up till Thursday. Then I'm moving to Valletta on Friday.
Okay.
The logistics on Friday might be tricky, but I'll let you know if I can't do it. But I work on the basis I can.
Yeah, okay, good. All right, well, have a good week over there. I hope the weather gets a bit better for you.
Thank you.
I hope the weather gets better for the markets as well. So thanks again, guys, and speak in a week's time.
Yeah, pleasure. Thanks, Paul. Thanks, everyone. Bye.